your credit report and score. Confused by your credit report and score and not sure what it all means? You've taken a great first step toward taking the mystery out of credit reporting. Why are your credit report and score such a big deal? They impact every area of your life. Potential lenders and service providers use your report and score to see how you've handled financial obligations and to assess the risk of extending you credit and services. And if you are approved for a credit card or loan, your score can determine your credit limit and the interest rates you qualify for. Insurance providers, landlords, and potential employers might use your credit history as part of the decision to provide coverages, lease to you, or hire you. And your history can even impact job promotions or your ability to pass a security clearance. Having no credit can be just as bad as having poor credit. Without a credit history, potential lenders and service providers have no way to assess your credit worthiness and decide if they should lend to you. Think about your credit report and score as your secret power. They empower you to purchase things, such as a car, qualify for housing, and gain access to wants and needs, like getting a cell phone. Handling your credit responsibly through on-time payments and not overextending yourself builds a history that shows potential lenders and service providers how responsible you are with money. And the way you manage your payments affects your credit score. Your credit score is tied to your credit report. It's a key factor lenders base decisions on. Most lenders use a FICO score model that focuses on 5 elements to come up with a number called your credit score. The 5 influencers are your payment history. 35% of your score is based on how you've paid your credit obligations. Consistent on-time payments typically improve your score. Amounts owed on your revolving accounts compared to how much your credit limits are on those accounts makes up 30% of your score. The lower your credit utilization, the better. Keeping use to 30% is a good target, and shooting for 6% is optimal. Length of credit history. The average length of time accounts on your credit report have been open makes up 15% of your score. The longer your accounts are open, the better. New credit makes up 10% of your score. It's tied to how many times you apply for new credit and how often someone checks your credit. There are 2 types of credit inquiries. Hard credit inquiries happen when you apply for credit. They stay on your credit report for 2 years. And each hard inquiry can bring your credit score down by as much as 5 to 8 points. Soft inquiries happen when you or a third party pulls your credit for informational purposes. And the last factor, credit mix, makes up 10% of your score. It's the mix of different types of credit you have. Creditors like to see a mix of installment and revolving accounts. Credit score ranges depend on the scoring model. The FICO model can range from 300 to 850. The higher your score, the better. Let's break down the ranges. 800 to 850 is considered exceptional. You could qualify for the best rates since lenders will see you as a very low risk to default on your payments. 740 to 799 is considered very good, and you're likely to receive better than average rates since you'll be seen as a low risk. The median range of 670 to 739 is seen as good. Lenders typically find this range as acceptable. Even though you may not get the lowest rates available, there's a decent chance you will be approved. A score in the range of 580 to 669 is considered fair. Lenders may be less likely to approve you if your score is in this range. If they do extend credit, it is likely to be at a higher interest rate. And finally, a score in the range of 300 to 579 is considered very poor, and you are more likely to be denied credit. If a lender extends credit, it typically has higher costs and rates or may require collateral or a cosigner. As we wrap up, let's look at what your score translates to in dollars. Suppose you wanted to buy a car and need to finance $20,000. If you have a credit score of 770, you might qualify for a loan at 3% interest. You'd have a monthly payment of about $360 and pay roughly $1,600 in interest over the life of the loan. But if you have a credit score of 580, 18% might be the best interest rate you can get. You'd have a monthly payment of about $510 and pay roughly $10,500 in interest. A better score could save $150 a month and almost $9,000 in interest. Understanding the effects of your credit history and score and using strategies to improve them can help you harness the power of your credit score. Visit TakeChargeAmerica.org or call 866-528-0588 to learn more about building credit and other financial topics, and to get help with credit card debt, student loans, and more.